Good morning, everyone. Welcome to this update for global stocks and commodities for the 11th of September. Everything was running along smoothly until Friday night, and there was a bit of a scare in the market, which frankly I think is just completely and ridiculously overdone. It's about rumour and what might happen, and has no real basis at all. And to me, it just absolutely smacks of the fact that there was perhaps a little bit of selling, and then the computers kicked in, and stop losses got triggered, and the market just fell away to the downside. But as we have to put up with these days, those moves tend to be quite exaggerated by the computer algorithms, and yeah, it was ended up being quite a nasty session. So what does it all mean? Does it mean there's a change in the market? There are people that are now worried about whether things are going to change in the bond market. So that's really what I want to explore in this particular edition. Just a few general comments. There has been this year quite a considerable amount of underlying strength in the global market space, not just in America, but in most developed economy stock markets. So that's the key thing. The US is quite obvious. It's at or was it basically new all-time highs and had broken out after a 2-year consolidation. So that one is very obvious that the US market is strong. But looking at other markets around the world, non-US markets, there's only 15% of them that are in downtrend, and something like 50% are actually in uptrend, with the difference being, of course, the ones that are just flat and trending sideways. But with only 15% of stock markets in a downtrend, that is a very positive scenario indeed. We're also seeing global banks, and you know that I've been quite strong in my view that I have great concerns about the European banking system, and particularly the Italian banks, and the Italian banks are still in disastrous trouble. However, against that backdrop, global banks are now breaking the downtrend that they've been in now for some time, and that's a real positive when global banks are turning the corner and starting to go up in price, perhaps not in terms of their business, but certainly the price action. Then that supports the broader market action, which has been quite bullish. So that's yet another positive. Some other positives in America, the technology sector has been going great guns. The Nasdaq setting new all-time highs. The Russell 2000 and the Dow Transports have been outperforming. These are all really positive signs, and you just don't get this sort of market action around a market top. And I'm sure that you'll read in the next few days, all the doom and gloomers will come out of the woodwork again and say, yeah, I told you so, this is the top, and we're going to all crash and burn from here. Well, I can tell you that the circumstances that are in place at the moment, it's almost impossible for this to be a market top, and I'll explain that a little further as I go through. So just ignore all the sensational headlines that I'm sure you'll read in the next few days that tell you that the market is topped, that the bond market's starting to fall apart, and that it's all over for stocks, because that is an incredibly unlikely outcome. Now, if you compound everything that I've just said above, the fact that there's great underlying strength in markets globally, notwithstanding the fact that we might now be getting a little seasonal correction in September. If you compound that by just focusing on just the best performing businesses that you can buy when they dip in price, then that is the best formula that I know to be successful in the stock market. However, the key rider is that one has to be patient on entry. So that means you might need to sit in cash for an extended period of time, or a higher level of cash. And you also need to be patient with the corrections. Don't get too anxious if you lose 5 or 10 or 15% on your portfolio. If you're in the right stocks and you've bought a dip, then it's really just a matter of time for the vast majority of them before they bounce back. And trying to trade in and out of this market the way it is at the moment, when you see such exaggerated moves as we're seeing, it's really, really difficult to do that. There's the the European Stock 600 Banks Index. You can see that it's broken that long-term downtrend in the last week or so. In the last day or so. So that's a real positive. When banks are leading, that's healthy for the stock market. So it's really hard to be bearish on the stock market at the moment, even though Friday night was pretty ugly. American stocks in general, the S&P ended up down 54 points on the week, and that was all on Friday night. Prior to that, I think the market might have been about 1 or 2 points higher. So that entire decline for the week occurred Friday night. Now we've had this very, very tight range. It had an upward bias to it. It was natural to conclude that the breakout would occur to the upside. It didn't. The market has fooled us again, but we've really got to be ready for that. Um, the bond market started to sell off. Now I'll come back to the reason that the bond market started to sell off in just a second. But the bond market started to sell off, and that kind of lit the fuse because people started thinking, well, if the bond market's going to sell off, then it's going to be really bad for stocks, and so we better get out. But look, this was just a one-day exercise at this point in time. It's not a trend. We need to see a trend of lower highs and lower lows in stocks and bond prices before we could, really think about starting to take some action. And to me, there just isn't a basis for it because a couple of the reasons that the bond market got a bit nervous was because during the week, the ECB didn't extend their accommodative programs any further. They didn't wind them back, but they didn't extend them further. And the Bank of Japan didn't extend further either. It's not that they started going into a tightening cycle, it's just that they're taking a pause. So the market took that as a real negative or as an indication that they were going to start to raise interest rates. And I mean, that's just crazy. The other part of the exercise was that apparently there's a Fed governor going to speak on Monday. And so the market kind of tried to fill in the dots and assume that this particular lady is going to allude to a rise in interest rates. Well, I mean, that's just pure conjecture at this stage. So to my mind, there is absolutely no basis for the bond market having sold off, and therefore there was no basis for the stock market having sold off. And it's really, I think, just down to we had an incredibly low period of volatility. We've had a volatility breakout. I've spoken about that now many, many times. A period of excess quiet will always be followed by some higher volatility. And the computers just took over and they've exaggerated the move. And it's just part and parcel of modern day markets, I'm afraid. So I still favour buying the dips strongly, not just a little bit. I'm still very much in that camp. Central banks have worked tirelessly, incorrectly and stupidly, in my view, but central banks have worked tirelessly for years to cultivate the wealth effect. Bernanke was quite explicit. He is trying to pump the US stock market up to create a wealth effect so that consumers will spend. And if consumers spend, then the economy gets better. Mario Draghi from the ECB has said similar things. So there's no question about where central banks' focus is going to be. So to think that they're at this point, when the economic data is still weak, and we had very weak economic data in America, that they're just going to toss that in and start raising interest rates. I mean, it's just, I just don't think it holds water at all, and that's why I think Friday night is, yes, we might get a bit of weakness in September because that's pretty normal, but I think Friday night is going to prove to be a bit of an aberration. I also think that given the US data, we can forget a rate hike in September, and the market is going to like that as well. The other key thing is that market tops occur when most people are in the market and there's little cash yet to come in to support the market. Some recent data that I saw, fund manager cash levels, not only in America but around the world, are the highest in 14 years, and they're higher than when the Lehman Brothers crash occurred. So if you just think about that, that's if there's that amount of cash on the sideline being held by fund managers, then it's almost impossible for the market to basically fall over from here, because that cash, stocks are still relatively attractive in America. It's not that they're attractive on a lot of measures, but when you compare it with all of the low yielding assets that investors would be comparing them against, they're still attractive. And with such high fund manager cash levels, I just can't see any way that the stock market can go into an extended downtrend. Technically speaking, several short-term supports were broken on Friday night. No question about that. It was a nasty move, as you'll see, particularly in the context of what we've seen recently. But look, I still stand by what I said earlier. I think this will prove to be an aberration. We saw extreme moves in August of last year, and we saw more extreme moves in January and February of this year, and we ended up setting a new all-time high. So I think that's what we're looking at the moment. My next support level is 2116 on the S&P, which is about 10 or 11 points below where we are now, so quite close. The next level then comes in at just under 2100. So we'll look at that chart in a minute. Corrections are normal and necessary. If this is going to develop into a bit more of a correction in September for a few weeks, then that's normal, it's necessary, and in fact, it's way overdue. However, what is not normal is the speed and the viciousness of these corrections. And again, that just comes back to the way that equity markets these days are dominated by computer algorithms. And it's almost impossible to try and trade around that sort of price action. You've just got to have the courage and the conviction about what you're doing to take a position in a quality stock. You buy it on a dip, and if you don't quite get your timing right, then just sit tight and wait it out. So from my perspective, stocks remain attractive relative to other low yielding assets, stocks in general that is, and the best stocks of course remain very attractive. So to wrap it up, this is not a time to be selling in my view. When I got up on Saturday morning and I saw that massive red candle, naturally your first reaction is to think, oh, my goodness, the market's really going to go down heavily from here. And I'm not saying that we won't get further declines, because I think that is quite likely in the short term. But I just put it in the basket of it's all noise. If you own quality assets and you didn't pay too much for them, then just sit it out. So let's take a look at the US market. So there's the S&P. You can see this is our key support line here, which was the breakout around 2135. We moved higher. We kept tracking with a bit of an upside bias, as you can see. The VIX index was extremely low. We'll look at that as well, because the VIX spiked by around 30% on Friday night. And then eventually we got the breakout or breakdown, and it turned out it was to the downside. You can see that's a very nasty move indeed. However, when we put a Fibonacci scale on this run up from the last dip that we had in June, then we get targets at 2116 and 2093, and then of course 2069. Now, if we put a bigger scale on that, and let's have a look at what it might look like if we started retracing the run from the lows of the year, which were in February. That then gives us a first level, and I can't really see the market getting much below that, because that would bring it back to the 200-day moving average. So that's around 2050. And if the market went below the 200-day moving average, that would just be totally inconsistent with everything that's gone before it, and all of the other signs that I've talked about. So I would think that's to 2050, which is about 80 points down from where we are now. I think that's worst case scenario. At the moment, I'd probably put my money on this level here, 2093, which is a 50% retracement of this run. I think this was such a big move on Friday night that I suspect the market will want to go a bit further down than 2116. So 2093, I think, is where I'm kind of looking at the moment. But look, the key is not to predict, not to try and have a firm target in mind. You can have an approximate target in mind as a bit of a guide, but just let the market show you the way is the key. I've said it many times. Just trade what you see and not what you think the market should be doing, and certainly don't trade what you read in the press, because a lot of it is just written by people who are chasing headlines. Let's look at the VIX index. Sorry, that's the wrong chart. There we go. There's the VIX index. So we had been trading down at incredibly low levels on the VIX, basically all-time lows around 10, and we've had a bit of a spike up. It had to happen. You just can't stay down at these incredibly low volatility levels for too long. We've had a spike up. You can see this is the spike in August of last year, which was when the market first took fright. And these are the spikes in January and February, which got to around 31, 32 at the peak. We then had another little spike, which was around Brexit, and it went up to 24. And to me, there isn't a basis for this. There was a basis for the January and February sell-offs because that was when the Fed first raised interest rates. There was a basis for this spike here because that was when we had the Brexit vote, and that caught everyone by surprise. So that's to be expected. In fact, I'm surprised that this spike didn't go further. This spike here, there is no basis for it. Yeah, there's some conjecture, but that's all it is. It's just people trying to second guess what's going on. There's no basis for what we saw on Friday night that I can ascertain at this point in time. Doesn't mean the market can't go lower and the VIX can't spike a bit higher, but there's just no basis for it at this point in time. Now, as a consequence, the US dollar went up a bit, but not a massive amount, and that meant oil and precious metals were under pressure a little bit, just really a currency effect. But while I'm here, let's just have a look at the Australian market. So the Aussie market was down a little bit on the week, but the Australian futures are pointing to about a 100-point decline on Monday. Whether that ends up transpiring or not, because I suspect that there was a lot of computer-driven selling in America through to Saturday morning. Our futures would have tracked that selling, but perhaps over the weekend, cooler heads will prevail and people will realise that the selling that occurred on Friday night was pretty heavily done. So I wouldn't be surprised to see the Australian market dip sharply on the open and perhaps then trade higher off those lows during the day. It'll probably end up down on the day, but I'd be quite surprised if it ends up by down more than 100 points on Monday. The Aussie dollar, first of all, rose when the US dollar fell, but then it sold down again on Friday night. So it's just moving in concert with the US and ended up in the mid-75s. The ASX down 33. And look, as I just keep saying over and over again, and I hate to be boring on this, but it's just so important. It's just focus on businesses with real quality and real earnings visibility for the next couple of years. Businesses that have got a particular niche or they've got a real moat against competitors around them. And if you just focus on that, then you're patient on the entries. You don't buy until you get a bit of a dip, and you're resilient through the kind of periods that we're probably going to get now for the next few weeks. Then generally you're going to do pretty well. Turning now to precious metals, gold ended up higher by $2 on the week, but it had spiked up above $13.50 earlier in the week with that poor economic data, and then of course got dragged down a bit pulled down about $10 or $15 on Friday. But net for the week, it actually went up a little bit. Now, this is how bull markets evolve. You need to get corrections along the way. We had a massive first leg in precious metals. The normal weak seasonality of June and July didn't come through. The market has fooled us again. But eventually you have to get a correction because there's just too much greed in the market. Valuations get stretched. There's lots of profit on the table. And eventually you have to rebalance that sentiment. And to a degree, it doesn't really matter what the fundamentals or the valuations are. When sentiment gets so stretched in one direction, it just has to rebalance. And that's what we're getting right now. We're getting a rebalancing of sentiment. It's good. It's healthy. You know, I know when you get up and you see a 10% plunge in the value of your precious metal stocks, it can be unnerving. I understand that. But you've just got to recognize how it is that markets work. And particularly in precious metals and to a lesser degree in energy stocks, this is just par for the course. So the bigger the bull market, then the bigger the correction in general terms. And generally, those corrections provide absolutely fabulous buying opportunities for the long term. I am absolutely convinced that we're in an extended bull market in precious metals that'll go for perhaps 3 to 5 years or longer, and that this correction, when we look back, which has already gone something the order of 20 to 25%, or it's probably a little more than that now. We'll look back at that and see it was just a dip. It was a great buying opportunity, and that's how we need to view it. Now, last week I mentioned that when it looked like precious metal stocks had turned up, and I said that the normal price and time correction had not yet been reached. The normal time for a correction was 3 to 6 weeks. We'd only been running for about 2. And normally, history would show that you get a pullback of 27% at the least to around 54% of the prior gain as the worst case scenario. Now, we hadn't reached either of those targets. And so I was a little cautious about that. But equally, I had to recognize that stocks had gone up by something like 8% in a session, which was pretty bullish. However, the market has come back to bite us again, and there were plenty of 5 to 8% declines on Friday night. So I think we're going to see a little bit more correction in the precious metals market yet, but it doesn't change anything about the bigger picture. So let's take a look at the precious metals side of things. This is the weekly chart on gold. So you can see a nice spike, and then it settled back down again and basically was pretty much unchanged. So whilst that was a fairly big move in gold stocks, wasn't actually a great deal in the underlying price of gold. There it is on a daily chart. So nice big spike on Tuesday, but basically gave it back during the rest of the week. Silver, a bit more exaggerated, but that's how silver works. But nevertheless, we're still clearly in a pretty strong uptrend. And if we look at the main stock index, GDXJ, I remarked last week that we hadn't yet made it back to the 38.2, which I thought was unusual. That was at 24.30. We dipped to here, about $1 above that. It may well be now that we'll see this complete and come back. So 24.30 would be an area on GDX that I'm looking at. Possibly $22, which brings us back to the 200-day moving average. But look, either way, whether we form a new low and we go to 24.30 or we go down to 22, this is a bull market, and there's a lot of money to be made here for years to come. But as I said again, with 5 to 10% moves in a session, this is not going to be easy. This is going to shake the confidence of anyone who is not totally confident about what they're doing. And you know, as members know, I get to work with a lot of different people, and I see the whole range of emotions. And it's easy before the event to say, "Yep, I'll just sit through that dip in the market. I'll wait it out." But when it actually comes along, it's very difficult to hold your nerve during those sort of periods. So that's where we're at with precious metals. Copper pretty much unchanged through the week. Crude oil moved around a little bit, but ended up a little bit higher, but certainly did dip on Friday. And as I've been saying, I feel that this is a little early to be calling a bull market in energy stocks, and it may well still be a bit early. So I'm by no means seriously bullish on the oil sector, but markets look 6 to 9 months ahead. I'm expecting the oil supply and demand balance to come back into neutral towards the second half of 2017, but that could be earlier. We'll have to wait and see. But the market will try and anticipate that in advance. So I think in general terms, at some stage over the next 3 to 6 months, I think this is a very sound contrarian play to be in the energy sector. We are seeing broad-based momentum across the whole sector. There's no question about that. Stocks are trading more positively, so I think it's a toe in the water exercise at the moment. There's the spot copper chart, pretty much unchanged. And so to wrap it up, I know this has been a bit longer this week, but again, big moves on Friday, so important to take stock. Equities in general. To my mind, the broad uptrends remain in place. Friday night was nasty, but I don't think it changes anything. Seasonal weakness is probable. September is the time of the year. September and early October is the time of the year when you're going to get some nasty stuff, some corrective action. So I think that's probable. If you're not expecting some more downside at the moment, then I don't think you're being realistic. Stock picking, absolutely critical. Just can't stress that enough. Don't try and do broad-based momentum things in the market. You just got to look at the Australian market. I mean, most stocks, forget the index, just look at a 100 of the best quality stocks in Australia, and some of the best, like CSL, for instance, carsales.com, REA Group. Some of our best stocks with global businesses are being marked down seriously for no apparent reason, mind you. And a lot of stocks in Australia, there's a lot more stocks going down than there are going up in Australia. So therefore, stock picking is absolutely critical. When it comes to precious metals, it's seriously tough trying to trade 5 to 10% moves in a session, particularly when they come back to back. You get 10% up and then you get 10% down the session or 2 sessions later. It's almost impossible to trade that. The only way you can play it is to decide what is a comfortable level of exposure for you, and know that you've bought a quality asset company. Don't just buy any gold stock, but make sure you're buying quality assets, that you're buying them at an attractive valuation, and hold your nerve through the volatility. And that's the hard bit. The stock selection, okay, it's not that difficult. The valuation, a little bit more tricky to determine what an accurate valuation is, but it's the holding your nerve through the volatility that really separates the wheat from the chaff. And then, of course, ramp up exposure according to the patterns, and the deeper the correction, the better the buying opportunity, I think, is the way that you've got to see the precious metals market. So that's it for this week. Bit long-winded, but very important, I think, right at this juncture. There's my contact details for non-members if you want to get in touch with me, and I'll be back with you next weekend. Cheers.